Hey everyone, this is Florian. I will be going over the newest Monarch deal. This is the first one that Jason Lee and I will be doing together since we announced our new partnership a few weeks ago. So happy to have one, kind of right off the bat. The deal is an escrow. Jason and I, similar to the last Inman deal, Jason and I are buying this outright on our own. So we don't need investor capital to close, which is nice because it means we take time answering your questions. You guys take time getting your due diligence and funds in, and once we have everything situated, we'll go ahead and fund the deal through the account and appropriate LC and such. So the deal is two one-bedroom cottages for 575,000. It's on a 7,600 square foot lot zoned RM 1-1, and that's basically a great recipe for the ADU potential. It was on the market like 35 days. The reason I saw it, or the way I saw it, was a price adjustment alert, and I never saw it come on the market, which is kind of odd. And I was like, how is this not an escrow, or let alone an adjustment in price? So I called the agent. First thing I asked him was, have you been in escrow? What's going on? And they said they had gotten offers from flippers, which you'll hear sometimes. People don't want to deal with those guys because they can sometimes waste time. I didn't want to alert them of like I thought that it was a great deal, so it was very much okay. Let me just get this under contract, and I'll worry about figuring out what's wrong with it later. One thing is I realized, or I found through historical records, the owner is a hard money lender, and they foreclosed on the property. So anytime this happens, these guys are like slam dunking because they made money on their loan and they get to sell a property. So it's very palpable that their MO was not looking for ADU construction deals, and they're just very happy to sell this deal and get out from it and pay their investors, all that. So that was a big thing. And then lastly, I sent this to Jason once it was under contract. I sent it to the ADU guys we use because they have so many agents sending them deals to buy themselves, and no one had seen it. So yeah, I don't know if it's something weird happened. I'm gonna assume that it just fell between the cracks, given interest rates are higher and all that. But what it really tells me is that the ability to find these types of opportunities are still very green in San Diego. That there's a shelf life to that, 1-2 years maybe. I think at some point it could be residential agents just understanding the value a little bit more and the prices go up, or it'll be investors understanding, and then the prices will go up through competition. So one way or another, again, my analogy is this is a gold rush, the ADU potential and the opportunities. And Jason and I are just trying to get as many of these as possible while the grass is green. Let me just talk about the area because it's important to take note. So we're in Southeast San Diego. Southeast San Diego is going to be your workforce housing, okay? Down here. So our first two deals we bought were right in this area. The reason it's important is understanding your demographic, right? So workforce, lower income, operationally, sometimes you'll have higher vacancy or people not able to pay rents. Maybe your units will get beat up more than when you're dealing with white collar or millennial type tenants. So just something to understand. And if you talk to an agent down here and a student investor, they'll call this a tougher part of San Diego. And if you're not comfortable with that, it could definitely cause awareness. But really, for me, what that means after understanding it is really having a great property manager who is really well situated and operationally experienced at dealing with this demographic. And ours is, they really the bulk of their units is all workforce housing. I mean, they're all in this area right here, going all the way into El Cajon. So they drove the site with us. They inspected the deal with me or with us, and they gave us rent comps because they know the area well. So am I worried about this area? No. At the end of the day, it's San Diego, California. Okay. And that's just going to be really good real estate as it relates to not only the rest of SoCal and California, but just the country in general. Okay, so yeah, we just want to keep buying in San Diego. Okay, going in the deal, we will be, here's your purchase price. The raise will be 750,000. That's going to come down a little bit. So 750,000 is the raise. I take that back. It's actually going to be 750 minus that. So call it 720, 710 to 720. We'll get you a number soon. And always transparent with the fees. So we're doing 2% acquisition fee, which is low given the purchase price. 2% asset management fee, and then the promote is always the one to figure out. 8/35 is what we're doing on this one. And how we come up with all these numbers, just a function of evaluating the deal, its returns, the opportunity in general and also the development, right? With a lot more intensive work for Jason and I to execute the business plan. But as always, this is a back end thing. So we don't get the promote, and we don't get really the bulk of our payment unless we do a good job. And we're holding this for 10 years is what we think. I mean, we've had conversations, talked about maybe a 2 to 3 year exit, but we just realized we're gonna have a low basis, new construction units in an appreciating area, in a market where it's tough to find deals. It's like, yeah, that's probably a good reason just to keep it and just cash flow and make money. Okay. So what the deal looks like, this is, I should have said the business plan, excuse me. So the business plan would be to scrape, I'll just do a street review real quick, scrape everything here and build 9 units, potentially 8, but probably 9 units. Okay. So as far as 9 units goes, I have 5,700 square feet to play with. That's how we play here. So right now I have all these just 2 bedrooms. That could change. This could turn into maybe slightly bigger 2 bedrooms, a couple smaller 1 bedrooms. These are deed restricted units. These 2 allow us 2 more bonus ADUs. So again, that's how we're getting to 9. These are our conservative rents. I always like to be at 300 a square foot for conservative construction costs. Sorry about that. And so the deal looks like this conservatively. So we're at a 14% IRR. Again, IRR, if you want to compare, I made 15% in the stock market last year. This is the metric to compare it with the as far as a real estate investment on a year by year basis. What I do like is that the equity multiple, even conservatively, is at 3.35. That's usually the upside of a lot of our deals. So I love that this is already over a 3, and that speaks into the leverage that we're using on this deal. So the cash flows, again, we like to be beating the stock market on this number by year 3. We're getting there in year 4, but that's conservatively. This number, the expense ratio worth talking about, new construction, I think we're going to be operating closer to 25 to 27%. How this 33 is going to get driven down. So the first is with the utilities. There's going to be what's called RUBS, which is the tenants paying back towards this. So right now I have this at 0. There will be some number here. We'll implement RUBS, and so that'll offset this number and therefore drive this number down. That's the first thing. $1,000 a unit for repair and maintenance. That's usually a good conservative number for regular apartments. For new construction, I expect this number to be a much lower, probably around half. And then really the taxes are where some of the savings, or a lot of savings, could come. The way taxes work, you get taxed on obviously where you are now, and then you'll get assessed on what you build. And a friend of mine actually is Jordan Marks. He's been working with the San Diego County Assessor for years. He's actually in this November, he's going for the actual assessor position. So there's like literally no one else better to answer these kind of questions than him. I called him. He gave me a good tip and to understand how to be padded here. He also told me once I scrape, we can actually go and assess and reassess and get lower taxes. So that'll be big. We'll do that. That was just a great tip already. Anyway, so long story short, I think we'll be closer to 25 to 27. Let me start tweaking this now and show you, a more realistic version, aggressive but realistic version of where we'll be. So I'm going to use 8%. This will drop us to 29, 30%, as you'll see. The rent, so manager told me $23.99 is what we can expect, and he hasn't been wrong since. Hasn't been wrong yet. Knock on wood. We'll use $275 as more realistic, and ideally, again, if we package all these deals together, these construction projects, if we can get into the $250 range, we'll save immensely. So $275 there. The refi here, I'm going to leave it. Again, if we did this deal today, this number would be 3.8 to 3.9. So a year to 2 years from now, I'm expecting them to be higher. Therefore, 5.5. I'm being conservative. So from there, it pencils. Okay. But generally, you can see this value already. Think about it this way: we're buying for we're buying for 575. Our construction is going to be 1.8, so we're basically into this deal for 2.5, 2.6, and we have something that has a $4 million value. So there's your big upside summed easily. So we're leaving this conservative, and now here are our returns. The IRR jumps to over a 20, which is fantastic. The equity is over a 4. These are higher returns than we've pitched. We want them to be higher because it's, again, quote unquote, riskier, all things relative and all things equal, because of the demographic, right? So on Inman, we had this as like 18 and 19% in a much better area. Therefore, yes, we want this to be better in just in theory. Even if this deal had been at 18 and 19, though, I mean, finding these deals are just, we want to do as many as we can. So 50% return by the end of year 2. End of year 2, what does that mean? I think it'll take a year to 2 years, a year to get permits back from the city, the plans. From there, a year to build, stabilize, refi, so end of 2 years, maybe a little sooner, but the way I model this is for 2 years. And again, it could get better very easily. Again, I mentioned if we are where I think we're going to be, even at the high end at 27%, I'll keep everything else the same. We just added 2% to the IRR, 2% more a year. Now we're at almost 70% returned. So you can see very easily we are able to increase the yield, very, very, almost exponentially, I would say, just by making little tweaks. Okay. Yeah, so that's the deal. Like I said, Jason and I are moving forward in this deal regardless. We're closing on it, and then we'll go ahead and knock on wood, everything goes well with the loan, obviously. But we'll look to fund it later on. We'll still play around with this, figuring out how big, how small do we want to make these units. But long and short of it is we know it's a good deal, great deal. We're excited about it, and we're just trying to find as many as we can as it relates to these ADU deals. Okay. Yeah, thank you for your time. The raise will be first come, first serve. And, as far as that's concerned, Jason and I are happy to hop on calls, Zooms, meet in person to answer your guys' questions. And we look forward to doing this one and many more with you guys. All right. Thank you.